All right, well, I think we'll get started here. We've got a small group today and probably a pretty pertinent topic to a few members that are looking to make some changes to their real estate or buildings in the near future. So we'll get started, but my name is Steve Kalina. I'm with MPMA, and I want to welcome everyone for joining us this morning. I've got again, a great topic that's very specific to some companies, and as most manufacturers are pretty busy these days, I think we're going to see more companies looking to expand and grow and move. And as the real estate market shifts, as COVID has probably had a big effect, we'll probably see some additional changes coming up. So today we've got a great program, and before I get to that, I want to just do some quick housekeeping. So for any attendees, you can use the chat function anytime you'd like, or the Q&A function. Either one will work fine, so you can post questions in there. If there are specific questions pertinent to the topic at hand, or what we're covering at that moment, we can potentially break in and ask that question. Otherwise, we'll save those questions for the end for some Q&A. So also, we've got some upcoming programs, of course. Hoping to get back in person come June. We've got some programs scheduled that are planned for in person. But in the meantime, we've got a program on April 8th, still a webinar that's on how to attract and engage your prospects to close more sales. So that's put on by a new member, BusyWeb. And then we've got a follow-up program on April 22nd as a part of our webinar series on business transitions. It's put on by CBiz. And then there's additional programs that you can check out on our website. Otherwise, we just kicked off, I think it was Tuesday, we kicked off our second cohort of our Skilled Training Academy at Hennepin Tech. So that was pretty exciting. So now we've got 2 classes going through, and lots of businesses asking about the next cohort. So we're gaining momentum there, and I think it's almost daily. I'm getting emails or phone calls from people in the community, different workforce development groups, people from DEED, people from just different groups that focus on workforce that are all asking questions about it or commenting on it. So it's getting lots of attention. And then, of course, we've got a few more weeks to wrap up the legislative session, and nothing too exciting this year, just because most of it's focused on COVID and racial disparities and things like that are important, of course, but not necessarily specifically the focus of MPMA. So we're kind of chiming in where needed and trying to help provide support in different areas, but nothing that we're passing for legislation or anything this year. So again, appreciate you joining in. I'm going to hand it over in just a moment to Andy Larson, who's with Larson Building, and great MPMA member and great general contractor on the west side of the cities here that is currently or has been working with quite a few of our members on building projects. So Andy and his team are great to work with and experts in the industry. So Andy's going to be kind of our MC today and introducing each of our speakers. So with that, I will hand it over to Andy to introduce the topic and the speakers. Go ahead, Andy.
Thanks, Steve. I appreciate everyone for joining us today for our panel discussion on real estate resources to expand your business. If you're considering expanding, building new, downsizing, or a major capital improvement project in the next 12 to 24 months, I think you'll find this session very informative. Before we get started, I'd like to introduce our 3 panelists. Joining us today, we have Jonathan Juris, VP of Corporate Real Estate. Jonathan is a member of Frauenshuh Corporate Real Estate Services team, provides representation and consultation to commercial real estate users, investors, and owners to support their firm's strategy and create value in their real estate positions. Jonathan's practice includes tenant and buyer representation, development, acquisition and disposition services, and strategic advisory services on a local and national basis. Jonathan and I are currently working together on a project, and I found him to be easy to work with and a true expert at his craft. Next, we have Miles Seppelt. Miles has been serving as the Economic Development Director for the City of Hutchinson since 2002 and was named Hutchinson's Business Person of the Year in 2017 and Minnesota Economic Developer of the Year in 2018. Miles and I have worked together on expansion projects for businesses in the Hutchinson community. Miles is an expert on economic development programs designed to incentivize businesses to expand and grow. Our third panelist is John Cassens. John is with DS+B CPAs and fellow MPMA member. John helps business owners develop strategies to grow their businesses. For over 10 years, John has focused working closely with businesses, advising them in various strategies to reach their goals, which often includes real estate transactions. His expertise in understanding the tax implications of real estate purchases and sales, along with knowledge of various economic development programs, allows him to make recommendations that help his clients achieve financial success for their company's growth. Before we get started, I'll go over the format for today's webinar. Each of our panelists will be given 10 to 15 minutes to share a snapshot of current market conditions, economic incentives, and tax strategies to consider. And at the end, we'll have a 10 to 15 minute time for questions and answers. So let's kick off our panel discussion today with Jonathan Juris. Jonathan, if you would, give us an update on the commercial real estate market.
Yeah, no, thanks, Andy. I appreciate being here and being a part of the panel. The industrial market has been really active, really busy. I've been in the business for 15 years, focused on industrial real estate, and for the first time, I think ever in my career, I advised a client to offer full price for a building, which was, everything's negotiable, right? So, and we ended up not getting the project or the property. So the market's extremely active. Space is tight, vacancy rates are low, and it's been a really active market. Are we going to have the PowerPoint presentation pop up here too, Lacey? There we go. Perfect. So I can just speak to this a little bit. 4.3% vacancy rates, which is very low. I think if there's some folks on this call that are out in the market looking for space, they'll probably find it challenging. Good space that has adequate, locations, clear heights, and power have been very tough to track down. I put that bullet on there for $87 per square foot, which is more or less an average sale price with an average building size of about 53,000 feet. So if you're a user that says, you know what, I only need a standalone 10,000 square foot building, you're likely going to pay over $100 a foot for that property, pending its construction. If it's a nice concrete panel tip up building, it's very possible you'll pay over $100 a foot. In fact, the quick analogy I brought up there about encouraging a client to offer full price on a building, that was on a 27,000 foot building in Plymouth, and it was a 22-foot clear height building with about 5,000 of office. And we offered $103 a foot. We didn't get it. We got outbid by $250,000, which I know that's very traditional in the residential real estate market, but here in the commercial world, we really don't see that. So it's just a reflection of, I think, low interest rates. Hopefully, everybody's on this call that their businesses are doing well and continue to do well. But let's also chat maybe a little bit on labor shortage. As we meet with folks day in and day out, we continue to hear finding good skilled labor is always a challenge to find, and employers have to continue to get creative to incentivize and lure in new talent. We've got Andy. You're the pro here to chat about this, but construction cost. Andy mentioned him and I are working on a project. That project is a little, well, I shouldn't say little. It's a nice development in Rogers, and the steel costs are just incredible. They're way up, and that's partially due to Amazon, right? We all, a lot of us are probably Amazon Prime members and enjoy multiple features and benefits. Well, these guys are building, I believe, 20 distribution centers across the country, and it's really affected the steel costs. So we're seeing rising costs on the horizon, and it's making it challenging for business owners like yourselves and operators to go out and build something. But with low inventory, it might only make sense. And of course, if you're building a purpose-built building and you're basing your building off of a a manufacturing line, then it probably makes sense to do something. Just to touch on rising rental rates, in the office warehouse world and light industrial world of the Twin Cities, we've kind of been coined this 850, 450 market. And what I mean by that is our warehouse rates when leasing were typically around $4.50 a square foot triple net. So you'd have CAM and taxes, your common area maintenance and taxes on top of that. And our office leasing rates were always around $8.50. Well, over the last 2-3 years, those rates have really increased. And it's partially because we've got a lot of new product being built. And we also have, kind of coastal investors coming into our market, and they're buying up big swaths of real estate. So a perfect example is there's foot industrial portfolio, and they're called Link Industrial. And Link has been really pushing rates, and they've been doing it pretty successfully. They're kind of making ripples in our market, but we're starting to see rates in that $12 an office per square foot range to $6 for warehouse ranges. So rates are on the rise. And with the the lack of inventory, it's really kind of switched this whole world to a landlord's market. Landlords are, they more or less are having to control in negotiations, and they're able to drive higher rates just due to the limited inventory. But there is some uncertainty out there unfortunately, with the civil unrest that's going on in the Minneapolis area, and then this pandemic stuff has been tough on others. So we've seen that kind of ease and tick down a little bit, but landlords are still clearly motivated to reach out and provide incentives to folks that are that run a great business and have great credit and a good history there. Just quickly touching on the sales volume, I just wanted to kind of back up my second bullet point there with a chart just to illustrate, where we stand from sales volume and it says Minneapolis, but it's really Twin Cities statistics versus the United States. So we're still a great place to do business, even though our taxes might not reflect that. But we're doing just fine, and we're still a great place to do profitable business. So if we could move to my second slide, that'd be great. Things to consider. I just want to chat with you all on just if you are considering a move, whether it is a purchase or a lease, or you're looking to build. If you're just looking to purchase or lease a property, and that's existing product, really you should plan for a good year, and maybe even longer. With how tight the purchase market is right now, you're going to need time to fully vet properties and understand the market. And when things come on, it's good to be able to act quickly. But in the back of your brain and for budgeting purposes, you should plan for 12 to 14 months. A good 12 months also for leasing. If you're out and you're going to be looking for lease space, get a good year ahead of your lease expiration. This will allow you to go out and negotiate on properties and do your homework and make sure you're making the right steps there. So you just don't want to find yourself getting stuck in you just don't want to get pushed into some critical dates to have yourself make in your business make a forced decision. So we like to say 12 to 14 months on average. And of course, if you're looking to build new construction, I would say upwards of probably a good 16 plus months. You want to be, aligned with a good contractor like Andy, and get in tow with an architect and really kind of map out on what you want, get a good understanding of construction pricing, and you want to be moving with time on your side. So another thing to do is inform your banking partner and attorney. that's something I always like to advise my clients and really CPAs as well. You want to kind of let those key advisors know what you're doing, what you're thinking, what type of funds are available to you, and also what other advantageous incentives might be there for you to take advantage of. I mean, if you're going to be selling your building and relocating to another one, it's really good to understand the 1031 implications there, and I think somebody's going to touch on that here. So that's great. And then also just teeing up your attorney. The reason I say that is, there's going to be negotiations of legal documents. So if you're, if I was your advisor, for example, I would obviously be able to review legal documents and make sure that all the business terms are reflected in that document, and there's not any irregularities that we see as we traditionally work through the process. But you're going to want a legal advisor to kind of provide counsel on leases or purchase agreements. So those are just other key partners to consider. And if leasing, understand all key notification dates, not only just when do we expire, but another big one is when do we have to give notice? We've ran into some challenges with other clients where they're like, oh, for example, my lease expires at the end of the year. Okay, well, if you read your lease, on this notification date, if you didn't tell the landlord you were going to be moving out, your lease automatically renewed. So now you're stuck here for another 3 years. So just really do a good job of understanding the documents you're signing. And I know for my clients and our Frauenshuh clients, we typically put together a really simple lease abstract. For example, it lists payment, lease rates and contact info, and really good priority or key dates and when we need to respond to those. So it's just a simple one to 2 page, depending on how big and complex the lease gets. But it's more or less the cliff notes of the book, if you will. When considering a move, another thing to do is really understand where all your employees are coming from. You always hear the famous real estate saying of location, location, location. Well, if you locate your building, let's say in the right spot, but if your labor is not there, it obviously a lot of different challenges come up. So we encourage folks to do heat maps and really just understand how a move might impact their employee base. Another good point here is negotiating a purchase or lease takes approximately 30 to 60 days. So again, how complex is the process? It can be complex given the property. So we like to say set aside a good month to 2 months to negotiate everything. So that would fall within kind of our recommended 12 to 14 month window. So just budget a few months there. And then another thing I didn't touch on here, but you're likely going to go move to a suite or to a new building that is not perfectly set up for your business. So you should probably, again, pending the complexity of the build out, I mean, you should maybe even budget in another 90 days. So if we look at that, if we say, okay, 90 days, you got 3 months there and you got 60 for negotiations. So you're at 5 months. So that really puts you in a window of, call it 10 to 11 months to go out and adequately find something, understand the market, and make the right choice. I put in the bullet of hire a commercial real estate professional, not only just because, hey, that's me, that's what I do. I think it's important to hire, whether it is a guy like me or some other commercial professional. It's as simple as, would you ever go to court without an attorney? I wouldn't. This is what we do. We do it day in, day out, only for the commercial sector of the business. I don't go sell houses on the side. In fact, the 3 houses I've owned in my life, I've always used a residential real estate professional, and even that residential real estate professional has said, well, hey, you've got your real estate license. Why don't you do the transaction? And it's because that's not what I do, and it's not my craft. So hiring a good professional, commercial real estate professional that represents your interest and really does a good job of it as advising and educating you on the market. As a professional, my goal is to work with my clients to more or less give them kind of a mini education in real estate. So when it does come time to make a big decision, because traditionally on balance sheets, real estate's always up there. So we want to make you well aware of all the market conditions, cost, timing of process, and just get you comfortable to make the right decision. So you know when it's time to sign a PA, purchase agreement, or sign a lease for the next 5 to 10 years of your business's life, that you're making the right choice. That's all necessarily I had. I kind of burned through that quick. So if I'm missing anything, I'm happy to capture anything in the question period.
Sounds good. Thanks for your help.
Yeah, thank you.
Just was going to touch on a few things. That on one of your slides, you had $87 a square foot for average real estate transactions, and I'd say if you can find it at that price, go for it. With construction costs, I mean, $87 a foot. I assume that includes land, correct? Yeah,
so that would be a land and building cost. Now, again, it's a market average, right? So I in a way, I was like, oh, maybe I shouldn't put this up there, but it's good for folks to know, because if you're looking at, let's say, more of a state-of-the-art facility where it's tip-up panels, let's say it has a clear height of 24 feet, good column spacing, power, etc., adequate truck court depths. I mean, there's so many attributes we look at. You're probably going to creep up towards that $100 a foot range. But if you can find something that's, metal constructed, then you'll probably be in that range. So the needle's really shifted here the last few years, and a big driver is also the interest rates. Not only, of course, we touched on the construction costs, but the interest rate. It's finally made a lot of sense for business owners to go out and buy property versus lease. So there's a few different indicators there that provide people a path. But yeah, $87 a foot. Yeah, tough to find a building to hold water to that today.
Just to put that in perspective for the audience, on the new construction side, like a 20,000 square foot building in the metro has some office spaces. A year ago it was probably $110 a square foot construction costs. Today, with inflation and pressure on the supply chain, that same building's probably new construction's $125 a square foot. So on top of that, you still got to acquire the land, and that's a nice segue into our next panelist, Miles. Yeah. Miles can touch on some incentives that would make a lot of sense for potential businesses to expand on a new site. So I'll just turn it over to Miles and let you run with it.
Okay, sounds good. Thanks, Andy. Let's go to the next slide. If we can go to the next slide. There we go. Just a quick preview of what I'm going to talk about this morning. And then at the very end here, we'll have a question and answer period. If there's any questions that come up, I'll be happy to answer them. So I'm going to give you just a quick overview. There's an item out there that everybody needs to be aware of called the business subsidy law. And then I'm going to talk about two sets of incentives. There's local incentives, and then there's some state level incentives that everybody should be aware of. Next slide. So the first thing we want to talk about is the business subsidy law. And this is a requirement. It's a state requirement that all cities and counties that provide public assistance for projects, they have to have this business subsidy policy in place. And basically what it does is it sets job creation and wage goals for any project that receives public assistance. So really what it boils down to is that whoever's doing the project, they need to commit to doing or saying, we're going to create X number of jobs and they're going to pay X amount per hour. And then all these jobs need to be created within 2 years of project completion. And then there's yearly reporting that goes with that. And so it's just something to be aware of. And one thing that I always share with folks that are doing projects, if you're getting public assistance, just be real conservative about the number of jobs that get created and the wages and so forth. If you commit to doing 10 jobs and you end up with 7 at the end of 2 years, then nobody's going to be happy. And On the reverse side, if you commit to 7 jobs and then you end up with 10, then you're a hero. And so I just say be real conservative, because you only have a 2-year window to create the jobs before, clawbacks start happening, and nobody wants to go there. Now, the city council can authorize a 1-year extension. I've done it. We've done it here in Hutchinson, but it's something that you probably want to avoid. So I just say be conservative when you're thinking about job creation goals and so forth. And then the other thing with respect to the business subsidy law that folks need to be aware of, it's a public hearing to set it up. And then if you had to do an extension to get the 1-year extension, there would be another public hearing. And so just be aware that that does need to happen. We're talking about public resources. So at the end of the day, it's going to be the city council or the county board that's going to approve all this. And then a key concept is just what's known as the but-for test, right? But for the assistance, the project would not happen, right? So in other words, no assistance, no project. Public assistance makes the project possible. Again, we're dealing with limited public resources, so we just want to make sure that there's a bona fide need there to help. The goal of these things is to help good projects move forward. So that's it. Next slide. I'm going to talk a little bit about tax increment financing. That's the most prevalent tool, and that's a local tool. And these things can get used for economic development projects or else redevelopment projects. If you're dealing with a blighted building, for example, and then they also get used for housing. Those are kind of the big 3 when it comes to tax increment financing. I'm only going to talk about the economic development type today. So next slide. Real quick on how does it work. In an economic development TIF district, basically what it does is it just captures the property taxes that you're paying on your new development. And so here's an example. If, for example, today you have a lot and you pay a property tax $500 a year, let's say, and then you put a new development on there, you build a nice new building and so forth, the property tax is going to go up to $20,000. That gain or that difference between the new level of property taxes and the original property taxes, that's the tax increment. So in this example on your screen, it'd be the 20,000 minus the 500. So then annually, the tax increment generated would be 19,500. So it's really just capturing the increase in property taxes that you pay. And then those dollars can go back to pay for qualifying project expenses. Next slide. Oops. Maybe go back one. I think we shot over one. There we go. With tax increment financing, 99% of these things, it's what's called pay as you go. So you do a project, you're going to pay your property taxes normally, just like you always would. Where TIF comes in, though, is that every 6 months or so, you're going to get kind of a rebate. A tax increment check is going to come back to you to reimburse you for those qualified project costs. And it's really based on the amount of property taxes that you're paying. That's what kind of drives that amount. So because it's a pay-as-you-go thing, I mean, these payments would stretch out for 8 or 9 years in the case of an economic development district. So typically what I've seen upfront financing through their bank, whoever the primary lender is for a project, they will tuck in some extra dollars to kind of front the TIF money. And then many times the tax increment can get pledged directly to the bank. So we do that, our city will just send the check straight to the bank, and that just becomes part of the loan repayment. So I think that's all I'm going to say about that. Next slide. There's 3 main types of projects that you can do with an economic development TIF district. And it goes a little bit beyond this, but this is the overwhelming majority of what's out there. So it's manufacturing projects, it's warehouse projects, and then oddly enough, call centers qualify for this thing. Next slide. And then the tax increment dollars I talked earlier about, they can pay for qualified project expenses. So that would include things like the purchase of land, any site work, soil corrections, parking lots, sidewalks, needed ponding, and utility extensions. So the rule of thumb, basically, it's anything in the ground can usually be paid for with tax increment. So, it can be pretty substantial. Next slide. The next local tool I'm going to talk about is called tax abatement. This is probably a little bit less common than tax increment financing. It works the same way as TIF because you're going to pay your property taxes just like normal, and then you'll get every 6 months or so, there'll be a check that'll come back that'll abate back a certain portion of the property taxes that you pay. It's way more flexible than TIF, so that's the advantage, is that you can use it pretty much for anything and everything. You can use it for pretty much any kind of project. There's really no limitations there. The drawback with tax abatement is it's probably a less powerful tool than TIF. Most of the time, it's only going to capture the city portion of the property taxes. With tax increment financing with TIF, I mean, you're going to capture school district taxes, the county taxes, and the city taxes. So there's 3 slices of the pie that you get to capture. But a tax abatement, most of the time, it's probably just going to be the city. So you're only going to get 1 slice of the pie. Now, it can happen. You can, they can go and ask the school district to participate. Sometimes they do. Most of the time, I think they don't. You can ask the county to participate, and that just depends on the county. I would just say they're probably less common that they jump in on these things. So that's it about tax abatement. Next slide. A couple of state programs I'm going to talk about that folks need to be aware of. There's what's called the Minnesota Investment Fund, and that's a good program. We've used it many times here in Hutchinson, but that can get you up to $500,000 or $1 million if it's a bigger project. And it's all determined on a point system. They'll just take the number of jobs that you're projecting on creating and the wages of those jobs. They work their formula, and then that's going to cough up a number that of the assistance that you could possibly get. And the way that it works, it's normally a grant that goes to the city or the county, and then they will turn around and loan the dollars to your business. And then sometimes it can be forgivable. I think that's more the exception than the rule, but it's a question that you're going to want to ask. But just be advised, I think that's less common. Typically, it's just a loan, but it comes in pretty handy. The banks like to have it because then they have another partner in when they're funding a project, and they like to have other partners in there. For Minnesota Investment Fund dollars, or MIF dollars as we call them, it's way easier for everybody concerned to use those dollars for machinery and equipment. It just avoids a lot of rules and bureaucracy, and it's just way easier to administer. You can use it for real estate, you can use it for a building, but then it just gets more complicated. And projects over $500,000, it's going to trigger prevailing wage. So you're going to kind of lose ground on that side. Like I said, it can be forgivable. And then the thing to remember is that there's job creation and wage goals that need to be met within a 2-year window. So, because that business subsidy stuff, that applies to this program as well. Next slide. The other program that's out there, and this one's pretty popular, it's a newer program called the Job Creation Fund. This is a pay-for-performance program. And so the way it works is that you're going to create the jobs, and then at the end of each year, the state will count up the number of jobs that you created and the wages that are paid, and then they'll cut you a check based on a formula. So this one is just pay for performance. I mean, you got to do the stuff on the front end, and then they'll write you a check. The beauty of it is it avoids any possibility of clawbacks or anything like that. So it's much cleaner and easier to use that way. So for the Job Creation Fund, there's a minimum required investment and a minimum number of jobs that need to get created. So in greater Minnesota, in the non-metro area, it's $250,000 of real property investment and 5 jobs. That's the minimum to qualify. If you're in the metro, it's double those numbers. And then any project that gets over 200,000 in assistance, that's going to trigger prevailing wage. Next slide. Like I said, the job creation fund, it works on a formula. And so here I have it. If you look at the second column, that's for greater Minnesota. It's just going to pay you X amount per new job created. So if you created 1 job and that job pays at least $28,950, then the state's going to pay you, they'll write you a check for $2,000. And then the program runs out for 7 years. So I mean, that can add up to some pretty decent assistance over time. And then to me, the real advantage is that there's a rebate on real property improvements. So if you're building a building or whatever, you could get up to 7.5% of that cost back. And that could be some real dollars. So the job creation fund, it goes up to $1 million typically. If it's a bigger project, it can go to 2 million. But it's another program, I guess, that's out there for you to be aware of. So next slide. We'll do the questions at the end. Next slide has my contact information. And if you have any questions about anything, certainly feel free to give me a call. I'll be happy to answer them. So with that, I'm going to turn it back to Andy, and I'll say thank you for attending today.
Sounds good. Thanks, Miles. And I would just encourage any listeners, if you're considering a project, the vast majority of our clients do pursue the tax increment financing. That's very common. We've seen it happen on new greenfield construction projects. We've also seen it on expansion projects. So if you have a business that has jobs and creates jobs, I think it's definitely something that I would, encourage you to pursue and check in. And oftentimes it's just a phone call to the local economic development director. Like Miles represents the City of Hutchinson. Most communities have an economic development director. That'd be your first point of contact. And but yeah, I think it's certainly something to consider, and we see it very often in helping our clients. So next, I'll turn it over to John Cassins and let him just touch on some, what's happening out there as far as tax law and some incentives that might make sense to be aware of. John? John, I think you're muted.
Sorry about that. So just to touch on a couple things there with the economic incentives that Miles just touched on. Employment incentives also are out there for the employee retention tax credit, as well as the work opportunity tax credit, both of which were extended through the end of 2021. So keep that in mind as you're looking at, all types of opportunities as it pertains to incentives and tax credits. That's another one that's a very big and hot button right now for business owners like yourself. Now, I don't want this section of the presentation to get eyes glazed over as we talk about technical details of tax considerations of real estate investment and stuff like that. So I want to discuss the benefits of the real estate without getting into the weeds on how we can keep tax efficient cash in the pocket of you and your family. So as Jonathan mentioned before, the 2 options for our real estate investments are obvious, right? We got build to suit, and we're going to either do that or purchase an existing building. And in our current environment, these 2 options are extremely enticing because of the access to capital and the low interest rate environment that we're currently in. Now, banks want to lend right now, right? We're seeing a lot of velocity of lending. And if you've had good financial performance through COVID and history with the bank, you have a great opportunity to leverage your financial performance through your existing relationship with your bank, right? As an owner-occupied building, or a portion of the building, if you're going to have some tenants in there, or build a space where have potential for tenants, that business credit history that you have from being in operations for X amount of years can be extremely beneficial to lending terms, as well as potential negotiating power, right? You talk about negotiating power with finding a site or purchasing, you also have negotiating power with your existing relationships as well. So, and then as a reminder for that, when you do get into your own building, you know, you might be used to paying rent to a landlord. Well, that rent paid from your operating company to your real estate investment company is also a tax deduction. So you don't lose out on that rent deduction that you have, that you currently may have had with your operating entity. You also get the interest paid on your mortgage as a tax deduction as well, similar to you do of a personal residence. So just make sure you're cognizant of that as you're looking at your opportunity to either build or buy. You know, building to suit, as Jonathan and both Andy obviously touched on before, can be more costly than an existing purchase, but your customization of space, meeting your needs, you know, ability to expand or have your growth needs built into that new site is something that can outweigh trying to find that existing space to fit your current needs. And as we know, as business owners, a lot of our net worth can be tied up in our company, right? So therefore, one of the biggest benefits of owning your own real estate as opposed to renting is that net worth increase and your diversification of assets outside of your business, right? I see that too many times, or a lot of times with business owners, is so much of your wealth is tied up into your baby, whether it be that operating company or the company that you purchased, that now you have the ability to diversify some of your net worth into something outside of that, which think of it like a 401k or something in that matter, right? You're just putting it into more buckets to diversify your risk. Now, two specific tax advantages here that you potentially have. One being, as Jonathan mentioned, a 1031 exchange. The other being an opportunity zone incentive. So a 1031 exchange allows you the ability to defer gains from a sale if you currently own your existing property, and you can roll that into a follow-up purchase. Okay, so think of it as prices have now increased on sales. You have the ability to roll some of that gain into your new purchase, but there are specific rules to follow. There's specific dates to follow as to when you find that property, as well as when you execute that sale and follow purchase. So just be cognizant you may want to work with a 1031 advisor or attorney to help with that. Opportunity zones are the other incentive out there as it relates to deferring capital gains. This was something that was put in with the tax law changes in 2017. Obviously, that administration was very real estate focused, so it's not surprising that we saw some of these real estate incentives out there and currently still out there and have a potential to be extended. And what this does is it allows you to find a section of where you're planning to either build or buy, and this can be found in a number of different resources. And if you do purchase or build in that area, you have the opportunity to reduce some of your capital gains when you do relinquish some ownership in that property or turn that property, so long as you maintain that investment for either 5 or 7 years. So you maintain that investment in an opportunity zone area, you can have a potential for a 10% reduction of your taxed gain. Likewise, for 7 years, you now have a qualification of 15% reduction in your taxed gain. So substantial dollar amounts there when you do go and change over that property. Right now, you must invest by 2021 to maximize those gains, but this may be extended, and it's currently in Congress for that. So TBD on that one. But like I mentioned, these opportunity zones, when you're working with a real estate advisor, make sure to ask those questions about it, because you might find an opportunity zone in downtown Hopkins or out in Hutchinson. So there's a lot of opportunity between rural and metropolitan areas that have those opportunity zones. Lastly, here for just assessing the needs of a purchase or a build is you really want to make sure that you do the financial analysis to truly understand your cash flow needs, right? Before, you're paying rent, and that's got to be basically your only cash flow needs, and as well as, CAM and real estate taxes and things like that. But now you're in charge of all of those things. So when you're doing that financial analysis, just make sure that that's getting built in. You talk about future capital improvement needs, maintenance, all of those items, insurance, all of those things now that you may not have had when you were leasing the space is something that needs to get factored in to the cash flow needs and considerations of taking on that property. So next, I want to hit on tax structure and advantages of owning your own real estate. So when you do purchase or build your own real estate, you want to make sure to have that in an operator or in an entity outside of your operating entity. So think of it as creating a new LLC. And the reason you do that is, one, from a legal liability standpoint, but also now you have the flexibility to do some things outside of your current organization. And what I mean by that is this opportunity for you to create a generational asset to your family members or other individuals that you want to really take care of is a big opportunity there. So when you start that new entity and you have that new asset, you may also be able to shift some of the tax burden or net worth to those individuals who may be at a lower tax rate than you. So think of it this way: if you're paying taxes 50 cents on the dollar from your operating entity, and now you have the ability to include ownership by family members, kids, things like that, who might be paying taxes at 25, 30%. Okay, well, now I'm saving real tax dollars by just giving some of that net worth to, or some of that income passing through to the family. One of the other great opportunities with this, when you do that, is making sure it's non-voting shares. So you want to make sure that when you do start to include family members in this type of tax structure, that it's non-voting, that you have control of the checkbook, things like that, because there are financial considerations that are there. And then lastly, I'd like to talk about the cost segregation. So here on the screen, you see we have a real life example of what a cost segregation can do for you tax wise. So high level, what a cost segregation is let's say you purchase a building for $2 million. Well, you want to break out that $2 million into depreciable assets in different classes. And why you want to do that is to maximize your potential for depreciation and accelerated depreciation. So here we have a project that is 1.25 acres, just about a commercial building, one story, about 5,000 square foot. Next slide, please. And a project cost was $2,250,000. Okay, so think about it this way: you close on your piece of real estate, right? You got that settlement statement. You paid $2.25 million for it. You hand that over to your accountant or CPA, and that's all you do, right? All it says on the settlement line is building, $2.25 million. Okay, well, if there was no cost segregation done or no looking into what those assets are, that might all be put down as 39-year asset building, right? Now your depreciation is spread out over 39 years. So you're not realizing those tax benefits until far, far down the road, okay? Now, if you do a cost segregation, you have the ability to take that project cost, look at the building or do a study on that building to say how much can be equipment or distributive trades to put it into a 5-year life. What can be put into land improvements or building improvements that now have a 15-year life. And then you have the non-residential real property. Think of it like the 4 walls of your structure, and then the land, which is non-depreciable. Now, the big incentive that's out there currently, and this is something that's in place now, I'm not going to say it's going to be in place forever, but you have the ability to write off all $270,000 and all $664,000 of this project cost now by doing your cost segregation. And what that means to you is if we're paying tax on 50 cents on the dollar again, we're looking at a potential $400,000 worth of tax savings there. Now, cost segregations are studies. You may have to involve someone outside of your CPA or things like that to actually do this study, especially on an existing purchase. It's a little bit easier on a new build for the site because you do have a detailed construction costs that Andy would provide, obviously, and that could help fit these things into this bucket. But that cost segregation study, even though it's money out of the project and out of your pocket, it's also a tax deduction, and it will also serve in putting more of this purchase price into those asset buckets. Next slide, please. So here's just the high level combined potential first year tax savings alone at a 40% combined rate. So based on the assets that were in these three buckets, the accelerated depreciation that's currently still available, amounted about $930,000 or so, $950,000 or so, which came into tax savings of just under $400,000 at a 40% combined rate. So think about what you can do is, instead of that $384,000 going to Uncle Sam, what other reinvestments you can make into the property or your operating organization as well. So it really just does, when you put it into dollars like that, really hammer in there the opportunity and the benefit of the real estate investment, as well as a cost segregation study done on that real estate investment. And here I'll adjourn and hand it back to Andy, and feel free to bring up any questions that may come up here as we move into Q&A section. Thank you for your time this morning.
Yeah, thanks, John. I'll just touch on a few things. And we definitely see our clients taking advantage of the 1031 transaction that you touched on, John. We also see almost all of our machining and manufacturing type clients on a new construction almost always pursue that cost segregation accounting. And a lot of times as a builder, we'll help provide the data and the backup information they need for that accelerated depreciation. But I think it makes a lot of business sense. So if you're considering a project, I'd suggest reach out to your accountant, see what your options are. And I think it'd be wise to at least know what's there, and it's a possible tool for you guys to consider. So with that, I'll just open it up to questions. Maybe Steve or could help facilitate the questions and answer session.
Yeah, so one question from Miles here. Obviously a lot of us hear in the newspaper and the news about some of the big players, doing new additions or new buildings, such as like Graco. We've heard, in the news lately, and then it seems like they have relationships with the city or the county and some of the economic developers. Do you see very often that small companies are taking advantage of some of those resources, and who should they be? I mean, obviously within Hutchinson, we know who to go to, but in other areas, how do small companies figure out how to take advantage of those resources and where to go to?
Yes, that's a great question, Steve. We do see small companies take advantage of these programs. I mean, quite honestly, they're designed more for small businesses. I mean, almost everyone I talk to in the economic development world would much rather be working with smaller companies, because that's where you get the most impact, actually. So if it's a smaller company, I would say by all means seek after these resources. And like Andy said before, hopefully you can go on the website of the city or the county, and then they'll have an economic development person that you can reach out to. And if there's not, then it would talk with the city administrator or the county administrator, and they can point you in the right direction.
Yeah, that's good advice, and I'll touch on that too. We're working with a client right now. I think he has like 8 employees, and he qualified for TIF. So I mean, I would second that. It's geared for small businesses as well. So I would not shy away if you don't have a lot of employees. So.
Well, this was a question for Jonathan, but I think it's kind of a big question. So maybe all three of you could give any insights you have. But if you look at the last year and you look at the civil unrest, the destruction, not only all the personal effects of COVID, but now, of course, more people working from home. I assume we're going to see less of the professional organizations send all their people back to downtown Minneapolis. You got people moving out of, the urban areas into the suburban areas. I mean, there's just this mass shift in everything. And now, of course, this week we found out, Hennepin County is going to start paying the $20 minimum wage to all of their employees. Do you guys see any major shifts? I mean, as far as, obviously office real estate, I'm sure we'll see a big shift in, but do you think we're going to see the Minneapolis area rebound? We got a lot of manufacturers there. You're going to start seeing companies that just say, instead of building an addition or buying new property in that area. Are you guys starting to hear companies looking to get out of the area and find some safer spots, whether it's for safe for physical safety or financial safety?
Yeah, I guess I can start with that one. Yeah, I think right now if anybody's been downtown Minneapolis, it's just really weird. I mean, the skyways are empty, big courts are empty. I mean, it's really bizarre. We are seeing a push right now of primarily office users leave the market. And those, obviously there's lease obligations in place, so you can't just get up and leave and leave a lease negotiation behind without some consequence. But those that do have expiring leases are starting to push and look for suburban locations. A little harder. I mean, I know we've got manufacturers here, but it's so not to speak of the office market, but a little harder for manufacturers and folks with process lines to obviously pick up and move. Moving's really expensive, and I mean they're in those facilities for a reason. So we haven't necessarily seen a bunch of manufacturers get up and move. Just I think that's primarily because moving's really complicated and inexpensive. But also just touching on the whole point of going back to work, right? I mean, that's kind of the buzz in our industry is when are people coming back and how are they coming back, et cetera, and are they ever coming back? I mean, it was just in the news that Target's vacating 985,000 square feet downtown and relocating 3,500 employees. I mean, that's an incredible swath of people there. So the answer is yes. I think people are coming back. They will come back once user confidence is back and safety, like you alluded to, Steve, is there and present. I think people will come back. But just talking to multiple different business owners and C-suites across the state, we're hearing that it's really challenging for business owners and managers, operators, et cetera, to develop a culture behind a computer screen. So I think, if you've got new people that's working for you, they're sitting at home, they're not necessarily picking up all the little nuances that you traditionally would in an office. So, is real estate going to stay an important cog of the process? Absolutely. Now that's more or less to maybe a services business or an office provider, but because you can't necessarily have a manufacturer work from home. So, but yeah, if anybody else has anything to add on to that, great, go ahead.
I just hope that Minneapolis doesn't become the next Detroit or something. It's just scary to think of what could happen. So hopefully you're right and that things start coming back. Well, I think we're at the time now. I think we answered questions that were that we had. So I want to thank everyone for their time. Thank Andy for facilitating. He did a fantastic job. Nice, beautiful segues and questions that you would follow up. So that was great. And all
natural.
Yeah, exactly. We're gonna have to hire you.
Thank you.
Your presentations are great. We appreciate the attendees that chimed in, and this program was recorded, so we'll have it available for anyone either that was on here or anyone who missed today wants to get a copy of it. And just a reminder, I know Lacey would probably get mad at me if I forget to mention this. We did just open up our golf tournament for registration, I think earlier this week. So now that we got a nice sunny, warm day, it's fun to start thinking about some summer activities. So we've got a summer social we're going to do outdoors, and then we're going to do our golf tournament again at the end of July. So hopefully everyone can join us for that. And did you have anything to add, Lacey? No. All right. Well, thank you. busy and healthy, and look forward to seeing you in person again soon.
Thanks, everybody.
Thank you, everyone.
Thanks, everyone.
I enjoyed it. Appreciate it.